Have you ever wondered if there's a smarter way to grow your wealth without constantly chasing the latest hype in the market? Well, today I'm about to share with you one of the most powerful tools in the investing world. A strategy that stood the test of time, delivered solid returns, and has the potential to grow your wealth for the long haul. But here's the catch. It's not about picking the latest trends or jumping on every tech stock that pops up. It's about a proven strategy that combines growth with reliable, consistent income. And right now, it's attracting attention for all the right reasons. In this video, we're diving deep into SCHD, one of the top dividend ETFs that's been a game changer for investors looking for a balanced, low-risk way to build wealth. And by the end of this video, you'll know whether SCHD could be the secret ingredient missing from your portfolio. So, what exactly makes SCHD stand out in today's crowded market? And is now the time to double down or pull back? Stick with me, because I'm going to break it all down for you, and I promise you won't want to miss the insights I'm about to share. By the end of this video, you'll know why this ETF has been outperforming the market for over a decade, and how it could potentially change the way you think about dividend investing. Let's dive right in. SCHD, a highly favored dividend ETF. Why does it get so much attention? Because it delivers on multiple fronts. SCHD offers substantial growth prospects, provides a higher return than most dividend-focused ETFs, and ensures steady, reliable dividend increases. Actually, it has a faster dividend growth rate than many other ETFs built around dividends. Currently, SCHD delivers a strong dividend yield of 3.62%, paired with an impressive 5-year dividend growth rate of 11.6%. When you compare this to other popular dividend ETFs like HDV, which offers a yield of 3.65%, or VYM with just 2.72%, SCHD clearly holds its ground. Over time, SCHD has proven itself to be an exceptional asset for portfolios that lean heavily on technology stocks. Meanwhile, the S&P 500 index has seen its weight shift toward a handful of tech giants. If you compare SCHD to other high-growth focused ETFs, it's important to note that it's not an apples-to-apples comparison. It's just not designed for that purpose. The mission of SCHD is clear: to offer investors a diversified portfolio that combines moderate growth, an attractive dividend yield, and reliable long-term dividend increases. Now let me give you a piece of surprising history. Before the AI boom in recent years, SCHD had actually outperformed the S&P 500 over a period of more than 10 years, starting from its inception in 2011 and continuing through to the end of 2022. During this impressive stretch, SCHD returned over 300%, while the S&P 500 delivered 274%. These numbers are significant because they highlight SCHD's ability to grow steadily without relying heavily on the tech sector's explosive growth, something we've seen in more recent times. However, as we know, the past 2 years have been a very different story. SCHD has delivered a solid return of 17%, but it has significantly lagged behind the S&P 500, which has surged nearly 60%. Now, I want to emphasize that this extraordinary performance from the S&P 500 is not the norm. It's driven by a handful of massive tech stocks that have seen their valuations skyrocket, particularly with the rise of artificial intelligence and other high-growth sectors. The rapid growth of these technologies has created an exceptional market environment, but it's important to remember that these conditions aren't typical and may not last forever. So, should you pull your money out of SCHD, or is now the perfect time to increase your position? The answer really depends on what you're aiming for with your investment strategy. If you're focused on finding a steady stream of income through dividends, SCHD is still a very strong option. It offers not only an appealing yield, but also strong dividend growth, which can be an essential factor for long-term wealth building. Additionally, if you're concerned about having a portfolio that's too tech-heavy or too reliant on the growth of the S&P 500, SCHD's balance could be a great way to diversify and reduce that concentration risk. Before making a decision, it's important to ask yourself a few key questions. What are you truly looking for in an investment? Are you interested in a higher dividend yield to generate consistent income? Are you focused on investing in a fund with steady, reliable dividend growth over time? Or do you want to reduce your portfolio's exposure to the volatility of the technology sector and add more stability with a well-rounded, diversified ETF like SCHD? As market conditions continue to evolve, it's vital to evaluate your personal financial goals and make sure your investments align with them. The market may be shifting, but by understanding what you need from your portfolio, you can make informed decisions that will help you achieve long-term success. Let's begin with BlackRock, a company that has shown resilience and growth over the years. Analysts have set an average 12-month price target of $1,145, which indicates a potential upside of about 12% from its current price. This forecast reflects optimism for BlackRock's continued success in asset management, especially given its strong position in global markets. As investors look for stable long-term growth, BlackRock's diversified portfolio and expertise in managing both traditional and alternative assets could drive that upward movement over the next year. Next up is AbbVie, ticker ABBV, a stock I've personally held for a long time. AbbVie remains a key player in the pharmaceutical and healthcare space, with its strong lineup of immunology, oncology, and neuroscience products. Analysts have set a 12-month price target of just over $200, signaling an expected upside of approximately 17%. This comes as AbbVie continues to generate steady revenue from its blockbuster drug Humira and is making significant strides with its new treatments, such as Rinvoq and Imbruvica. With a solid pipeline and strong dividend returns, AbbVie remains a compelling choice for investors looking for growth combined with stability. Now let's take a look at Cisco Systems, a dominant force in the networking and cybersecurity industry. Analysts have an average 12-month target of $63.50, suggesting a potential upside of 7% from where the stock is trading right now. Cisco's consistent performance in cloud computing, data centers, and security solutions positions it well for future growth. The company is evolving its business model, shifting towards software and services, which could provide a steady revenue stream and drive future upside potential. Investors are keeping an eye on how Cisco navigates the shift from hardware to software-centric offerings. Next is Coca-Cola, ticker KO, a brand that's recognized worldwide. Analysts are forecasting a 12-month price target of $74, representing a solid 20% upside from its current price. Coca-Cola continues to capitalize on its global distribution network and brand power, diversifying the healthier beverages like bottled water, teas, and functional drinks, with a strong market presence and steady cash flow. Coca-Cola is focusing on expanding its healthier options to cater to changing consumer preferences. The company's continued expansion in emerging markets and solid dividend history make it an appealing option for long-term investors. Next, we turn to Bristol Myers Squibb, a leader in the biopharmaceutical sector. The company's average 12-month price target is set at $61, reflecting a potential upside of 8%. Bristol Myers Squibb has a robust pipeline with key drugs like Opdivo and Eliquis, and its recent acquisitions such as Calgene have enhanced its presence in oncology and immunology. As the healthcare industry continues to grow, the company's focus on cancer treatments and cardiovascular therapies is expected to drive strong revenue growth in the coming year. Texas Instruments, a titan in the semiconductor industry, is next on our list. Analysts have pegged the 12-month price target at $217, signaling a potential 15% upside. Texas Instruments is known for its strong position in analog and embedded processing, which are integral to the growing Internet of Things (LOT) sector. The company has consistently demonstrated strong financials with a commitment to returning value to shareholders through dividends and share repurchases. As demand for advanced chips in automotive, industrial, and consumer electronics continues to rise, Texas Instruments is well positioned to benefit from these trends. Finally, PepsiCo, ticker PEP, rounds out our list, with analysts projecting a 12-month price target of $185 per share, representing an impressive 22% upside from current levels. PepsiCo remains a powerhouse in the food and beverage industry, offering a diverse range of snacks, beverages, and health-conscious products. With popular brands like Lay's, Gatorade, and Tropicana, PepsiCo's strong product portfolio and global reach continue to drive consistent revenue growth. Additionally, the company's commitment to sustainability and expanding its healthier food offerings will likely contribute to its long-term growth. Investors are enthusiastic about PepsiCo's ability to continue thriving in an evolving market. Each of these companies represents a strong growth opportunity in their respective industries. As you evaluate your own investment strategy, keep in mind these price targets as they reflect analysts' expectations based on both current performance and potential future growth. It's important to consider not just the upside potential, but also the stability and long-term prospects these companies offer to build a well-rounded and diversified portfolio. It's also crucial to factor in the dividends and the consistent growth of those dividends, which add significant value to your investment strategy. The potential for dividend income compounded over time can substantially enhance your overall returns. Something that many overlook when simply focusing on capital appreciation. The approach behind this ETF is a time-tested strategy that has been effective for over 10 years. It's important not to get caught up in the frenzy of chasing growth for the sake of growth. Instead, prioritize high-quality companies that may currently be undervalued, just like many of the top holdings in SCHD, which present some attractive opportunities right now. Building sustainable generational wealth requires more than just picking stocks with the highest short-term growth. It's about maintaining a balanced portfolio, ensuring you're diversified across sectors, and adhering to the classic investment principles, buying undervalued assets when others are fearful and selling at a profit when prices are high. Let's talk about diversification for a moment. As we've seen in recent years, certain sectors, especially technology, have driven the market to new heights, but they've also introduced heightened risks. A well-diversified portfolio like SCHD helps mitigate that risk by holding a variety of assets across multiple sectors. Not only does this help protect against sudden market shifts, but it also positions your investments to grow steadily, even in uncertain economic conditions. As more investors realize the importance of diversification, ETFs like SCHD that focus on broad exposure to quality dividend-paying companies have been seeing increased popularity. So, what's your take on SCHD right now? Are you sticking with it for the long haul? Or are you thinking about adding more shares to your portfolio while some of its top holdings are still relatively undervalued? Share your thoughts in the comments below. I'd love to hear your perspective and discuss strategies with you. I truly appreciate you being here today. If you haven't already, don't forget to smash that like button to show your support. Your journey to financial freedom continues, and I'm excited to be part of it. Here's to your investing success. Profitable investing.